Good morning, everyone, and welcome to FLG's webinar on extending cash lifelines for tech in a shifting economy. Today, we're going to discuss why and how tech companies must extend cash runways during economic uncertainty. Before we start, I just want to let everyone know that you're welcome to ask questions in the chat, and we'll tackle them at the end of our discussion. I'm Heather Ogan, CFO and Administrative Partner at FLG. Please welcome CFOs and FLG partners, Fuad Ahmad, William Atkins, Bob Finley, Anne Samak de la Cerda, and Jonathan Walter. We are fortunate to have these truly world-class CFOs here today to share their insights. Would each of you please briefly introduce yourself to the audience, starting with you, Fuad?
Thank you, Heather. Fuad Ahmed. I'm a partner CFO at FLG. I've been at FLG for well over, I say about 12 years now. I'm based in the Bay Area, although I have clients all over the country. I've been a career CFO stretching back to early 2000s. My area of focus is tech software, although I've also had clients in med devices, pharma, hardware, pure hardware. But I focus on public companies primarily in the tech space. So look forward to sharing some insights.
Thank you. William?
Thank you, Heather. I'm William Atkins. I've been a CFO for about 20 years, having been an investment banker for 20 years before that. I think we're all seeing that tech is expanding to cover a larger number of areas, and I suppose my career reflects that in that I've been CFO of public and private companies, and I've worked in the hardware, services, and software sectors. I've taken a number of companies public and have been involved in a lot of mergers and acquisitions, and I'm really looking forward to today's discussion.
Thank you. Bob?
Thank you, Heather. First of all, I want to apologize. I woke up this morning and there was a problem with my video, so that's no reflection on my interest level. It's just better living through technology. I've been a CFO for about 25 years and typically work with startups from Series A through Series E. The sectors I work in are hardware, software, AI, and very, very happy to be here.
Thank you, Bob. Anne?
Hi, good morning, everybody. I mean, like my partners, I've been a CFO for about 20 years in technology roles, education, medtech, both in Europe and the US, currently based in the Bay Area. And my practice as an FLG partner, I've been at FLG for 5 years now, is focused on interim roles at a private VC-backed Series A to Series E company.
Perfect. Thank you. And last but not least, Jonathan.
Sure. Thank you, Heather. I've been a CFO for 30 years, prior to which time I served public companies in a national accounting firm. I've been a CFO of technology companies ranging from software development to hardware manufacturing, and in recent years, multiple IPOs and 2 SPACs. And I'm looking forward to our discussion. Thank you.
Thank you, everyone. Once again, it's a pleasure to have you all in the same space to discuss these critical technology issues and trends. So here's where we are today. While tech IPOs took a significant downturn in 2023, the first half of 2024 experienced a moderate uptick. The general sentiment for the back half of the year is cautious optimism. Risk is more pronounced, interest rates are higher, making bad decisions more costly. And we face volatility due to geopolitical challenges and a recent US election outcome. So how can tech companies survive this level of extreme volatility until the environment becomes more favorable? Today, we'll tackle this question and we'll share ways tech companies can successfully navigate these uncertainties, specifically around interest rates, M&A, financing, geopolitics, US politics, and the impact of artificial intelligence. So Fuad, I'd love to start with your thoughts on the M&A environment. How would you recommend we think through the current environment to take effective action?
Thank you, Heather. I would start by saying that the M&A landscape in 2024 has been characterized by gradual recovery. I think there's been notable variations across sectors and regions. I think, as we look back after a subdued period over the last year or so, global M&A activity has shown signs of resurgence. In the first half of 24, deal values increased by almost 5% compared to the same period in 23. reaching almost 1.3 trillion. However, the number of deals declined by 25%. I think this indicates that the focus has been on much mature, larger transactions. One thing to note, though, is there's a fair bit of resurgence that is focused on AI. I mean, AI has been a significant driver in the M&A activity. Companies are pursuing acquisitions to enhance their AI capabilities and maintaining competitive advantage. There is a lot of focus on M&A activities related to that. Another area has been focused, and in this case, this is mega deals. Just the two monster deals last year or this year were the ExxonMobil's $60 billion acquisition of Pioneer National Energy and Natural Resources, and Chevron's acquisition of Hess. And now, if we look at specifically at the U.S., M&A has experienced a 26% increase in deal value year to date, totaling 1.1 trillion. I see PE buyers are back to the same level of activity in tech as they were a year ago. And I'm also hearing from bankers and some experience with my clients a resurgence in middle market PE activity. And I think that bodes well for the M&A space. And I think the recent interest rate cuts and the expectation of continued cuts, I think will also help the M&A space. Sort of looking ahead, I think it's going to continue to see recovery, the M&A, with easing interest rates and less uncertainty about ongoing economic conditions. I think sectors such as technology, energy, healthcare will continue to be hot for M&A, but we'll have to be kind of mindful of the regulatory framework in the U.S. and in Europe in particular, and just your natural normal geopolitics that'll play into any M&A activity, especially cross-border. So we'll just have to be mindful of that.
Got it. Thank you so much, Fouad. Now let's shift to interest rates, because Fouad, you've talked about the interest rates going down and how that's impacting. It's a tough lending environment, though. Even though rates may come down, we don't know how soon that might happen. So, John, what can you share with us about the current state and trend of interest rates?
Thanks, Heather. Well, to make somewhat of a foundational or a fundamental observation here, we in the United States and the developed world economies are really exiting what's been approximately a 14-year period of unusually low, perhaps one could say artificially low interest rates. This has yielded less penalty to future years when you consider discounting future anticipated earnings. One can argue, therefore, that this has led to a lower cost of risk, and as a result, required less precision and rigor in allocating and/or investing capital. Now, with our return to a more normal interest rate environment, the discounting of future earnings is yielding a greater impact on those future earnings at a higher interest rate. Therefore, in fact, it's causing a harsher judgment and value set, more rigor and discipline in selecting potential investments and future opportunities. So what worked for the last 14 to 15 years is suddenly has been for the last 2 years, facing a more harsher reality and judgment. And I'd also suggest that we should likely not expect to see interest rates return to what has been this favorable environment to the past 14 years or so. Rather, it's likely to settle back to a more stable interest rate environment that was similar to periods before 2008. Thanks, Heather.
Got it. Got it. Thank you for that, John. It's always interesting to consider the historical parallels as we look ahead. It's always good to look back, see what happened, and then, use that to advise us as we move forward. William, is there anything you'd like to add regarding interest rates here?
Sure. What I'd say is, obviously many tech companies in the current environment are aiming to be IPO or M&A ready. And so these companies are appropriately focusing on ensuring that their business models are robust and that they can stand up to the scrutiny of public market investors or corporate or private equity inquirers. So I'm going to focus on why it's nevertheless a tougher environment than what the headlines might indicate, starting with IPOs and then moving on to mergers and acquisitions. Given the backlog that's built up in VC portfolios where levels of cash returned to investors are at historic lows, everyone wants to get back to having liquid IPO and M&A markets. And the limited partners in venture capital funds have seen negative liquidity over the last 4 years, and they need more exits to get back into positive territory. The problem today is that with interest rates at their current levels, and even allowing for future cuts, we aren't there yet. Regarding IPOs, if you look at the headline numbers, the public equity market has performed very strongly this year. The S&P 500 has gone up some 25%. But if you look under the hood, you can see that this performance was heavily concentrated in the handful of Magnificent Seven tech stocks. And stripping these out, the market would have been up less than half of that. And small and mid-cap indices have basically been flat this year. So we don't yet actually have a broad-based recovery in investor sentiment. And that broad recovery will be necessary for the IPO market to open up properly. Investors have much higher hurdles to jump, even at current interest rate levels, whether they are hedge funds buying into an IPO or public companies or PE investors buying a startup out of a VC's portfolio. Here's a worked example of what interest rates are doing to public market M&A sentiment. A typical investment grade corporation will borrow at, say, 6 to 6.5% today. That's basically the equivalent of 5% after tax, which translates into a 20 times PE. Well, that means that any company buying a company in the public market that's trading at, say, a 25 times PE is going to have earnings dilution without meaningful cost savings or synergies. So this factor is a major factor and a major reason for investors to hold back. So I don't think we're out of the woods yet.
Very helpful, John and William. And I agree, we're certainly not out of the woods yet regarding interest rates. But let's move on. Let's move on to financing. Fuad, I'll call on you next to give your take on the current state, appetite, etc., and any other recommendations you may have in terms of financing.
Sure, Heather. I'm going to break it down between venture and IPO and then some PE stuff. So let's start with the venture funding environment, right? We started the year well. The first quarter of 2024 saw a modest global rebound in venture capital, reaching a little over 58 billion. And that was driven primarily by investments in generative AI. However, the deal volume dropped to a 7-year low, down to 6,200, indicating, continued caution among investors. Here in the U.S., we experienced a sharp slowdown in the third quarter with a 32% drop in VC deals to 37.5 billion, reflecting some continuing economic uncertainties and limited liquidity prospects. And I'll talk about the IPO market in a little bit. AI startups captured a significant attention in Q3 again, comprising almost 31% of the global VC funding in Q3, up from 13% in 2022. While other sectors like fintech have seen declines and investors shift to more sexier technologies like AI. The IPO environment in 24 is sort of mixed, with signs of recovery in the US, where the number of IPOs increased to 60 in the first half of the year, reaching a cumulative value of 14.5 billion. Though the activity remains historically low, the historical averages have been substantially higher, and this amid continued investor sentiment. I believe the market trajectory will likely hinge on central bank policies, interest rates obviously being one of them. Geopolitics always play a big role, and then potentially easing inflation as we see that happening. So we'll see the IPO market open up, and that could all catapult the IPO environment, into 2025. In terms of venture capital and private fundraising itself, which is a precursor to financing in for the deal value, there's been challenges with VC commitments down significantly from 2022 highs, and PE fundraising almost showing a 25% drop in new funds. So, however, again, sectors like AI have shown substantial VC attention, and some large PE funds such as New Mountain Capital closed a 15.4 billion fund in Q3. I mean, that indicates continued interest in established firms, strong stock records. Investors are, prioritizing liquidity, their investors, and they're focused on funds with proven performance in this environment. As I look ahead, fundraising in both VC and PE is expected to remain competitive. I think the firms will need to adapt, demonstrating robust value creation, firms that are looking for financing. And some focus will, some sectors will always be in focus for the VC financing. And then finally, I think it goes without saying that macroeconomic environments like interest rates are always going to be a overhang on any financing activity anytime you see that. Geopolitics play a big role in it, but I think that is normal. I think that's, from a perspective of fundraising, that's always something you have to worry about. But that's something that we're seeing right now, that I'm seeing with my clients, and I'm seeing that in the market play out.
Thank you so much, Fuad. And is there anything you'd like to add to this, perhaps as relates to earlier stage companies?
Sure. I mean, we've heard a lot about the environment at a macro level, and I'd like to make it what are the takeaways for small and medium-sized companies in the current environment, right? So given today's challenges, it's clear that the imperative for companies is to be resilient. And that means cash management, disciplined cash management, to adjust to market conditions. We've heard about it, not a lot of liquidity. And 3, strategic approach to funding. Because with venture capital still there, but less abundant, smaller firms really should avoid risky expansions and instead focus on sustainable and profitable growth. So, I mean, on cash management, this environment clearly favors companies that have strong fundamentals and can demonstrate ROI on their investments. Companies right now really need to deprioritize nice-to-have projects and ensure that every dollar spent is tied to a clear path to revenue or efficiency. This is quite timely. We're all doing budgets right now. Look at those investments and what are the return on investment in terms of top line. Number 2, on IPO and M&A market realities. I mean, like William said, there are quite a few companies queuing up, and the market thresholds are really high. So not only it requires proof of profitability, but also really an extremely compelling market position. So companies should align their strategies and demonstrate that growth and profitability, and also their positioning in order to attract investors or acquirers. And then finally, on financing, again, Fuad said this, 30% are still hard for investment. AI is still hard for investment, but many others are not. So companies should really build on building a capital efficient model that aligns with investors' priorities. And so at the operations level, at the finance operation levels, here are some quick actions that I can think of that CFOs should think about right now. There's number 1, establish clear warning cash metrics. If you don't have a 13-week cash flow projection, do it. Get your teams to do it. Number 2, optimize cash conversion cycles. This is very basic, but aligning your providers and customers' payment terms is going to be quite key. Of course, right-size operational spending if you haven't got there yet, and then build a financial war chest. This is the time to maybe think about that additional credit line if you have the option to do it. Just go and negotiate it. And then last but not least, keep transparent and good communication with your stakeholders, because surprises are not what you want to do in this tough environment.
Got it. Thank you so much for sharing those great action items. And I so agree, nobody likes surprises. So that last comment on transparent communications. But I hope everybody's been taking notes and getting all these great pointers on what we should be thinking about right now. So let's move on to geopolitics. Bob, We have a new US government administration moving into the White House in January. Can you please give us an idea of what we're looking at in 2025 and beyond by way of the geopolitical environment from your perspective?
Sure, Heather. This is very early in the presidential transition, so things are changing on a daily basis. Let's recap what we know and what we think. We know the next Secretary of State will be Marco Rubio. Rubio is known to be a hardliner on China, Iran, and Venezuela. His view on the Ukraine war is that the conflict has reached a stalemate and, quote, needs to be brought to a conclusion, end quote. Michael Waltz has been tapped to be the National Security Advisor. He's a former Green Beret who has also taken a hardline stance on China. With those two appointments apparently settled, let's talk about three topics. Number one, Russia. Number two, China. Number three, tariffs. First of all, Russia. It seems like Russia may be handing part of Ukraine as part of a settlement to end the war. Talks say that Russia will use the time to rest, rearm, and re-equip. There is some fear that Putin might invade Poland next. If you have teams actively working in Ukraine, you probably want to make sure they are in the western half of the country. You may even want to exit Ukraine. In a longer-term scenario planning, you may also want to consider scaling back your investments in Polish workers as they may be in peril down the road. Number two, China. Does anyone like China these days? It seems not. From a geopolitical perspective, some people worry that if Trump gives Putin part of Ukraine, it could embolden Xi Jinping. Xi has stated that his goal is to reabsorb Taiwan into China by 2027. Last week, interestingly enough, I was having dinner with a CEO who is Taiwanese. She stated that no one she knows is afraid of invasion. However, if you are actively sourcing goods from Taiwan, you may want to diversify your supply chain. Again, basic risk management. Now let's turn to tariffs. Donald Trump has said that he would seek to implement tariffs up to 60% on goods imported from China. If you depend on China as part of your supply chain, we recommend you seek out alternate suppliers immediately. Also, ask your finance team to do some scenario modeling that shows scenarios where your cost of goods sold or bill of materials increases 20% or 40% or 60%. We anticipate that consumers will not be willing to absorb the full impact of any price increases due to tariffs. So you want to be aware of what the impact could be on your P&L and cash flow if your demand slackens due to tariffs.
Thank you so much, Bob. This is just for me so reminiscent of the COVID days when companies had to rethink their supply chains given shutdowns in various parts of the world. So the good news is, I think the people still have good memories of how they addressed and adjusted to that. But these are very, very important considerations. John, what are your thoughts on the U.S. domestic business environment, given the outcome of the recent elections? What should we be thinking about in your view?
Well, thanks, Heather. I think that domestically, look at what's happening, and as Bob said, it's changing daily. And what can the CFO do about it? We know now that the Republicans will control the White House, the Senate, and the House of Representatives, and that the Congress is committed to support President-elect Trump. Late in his campaign, Trump said, promises made will be promises kept. Therefore, what actions can we expect, and what could the consequences of those actions be? Throughout his campaign, Trump focused on four things: international trade policy, which means, as Bob said, tariffs, interprets as tariffs; less focus on fiscal policy, that is, spending at the consumer level. Number two, reducing regulation and bureaucracy. Number three, controlling the border. And number four, maintaining a lower, not higher tax assessment. Also, we periodically heard that the president should have more of a voice in Fed policy decision-making. The consensus so far of informed observers seems to be that in terms of tariffs, potential to start trade conflict and wars will likely cause cost increases. And these are going to be passed on to buyers in the economy, pressuring inflation. Reduced regulation and bureaucracy is aimed at both seeking efficiency and reducing the deficit, but cost reduction is not going to come easy. Remember, approximately 1/2 of federal spending is committed to locked-in health and social transfer payments. But the consensus is that cost opportunities are going to be quickly identified and advertised publicly, and then attempts made to be cut. Hard to say exactly where this impact is going to come first, but we would think initially, expect a less constricting SEC. Third, the border. Expect a sharp reduction in inflow and in illegal inflow. Observers see this may affect reduced employment supply at the lower skill level and also be inflationary. Taxation, expect 2018 tax reductions to be extended and even lowered at the corporate level. Potential consequences of these suggest that inflation may well remain a threat. That, coupled with apparent pressure from the White House on the Fed Open Market Committee and pricing decisions, stability and reduction in short-term rates should not be assumed to be locked in. We've seen that as the Fed has reduced the Fed funds rate, the 10-year Treasury has been a little less flexible in coming down, has even increased over some periods. And as we've said before, as interest rates reflect the penalty of holding for a longer period of times, interpret this uncertain relationship as having consistency until certainty is ensured. So what is the CFO to do? I'd recommend two actions. First, make long-term financing decisions cautiously. It may be safer to lock in longer-term debt costs at these levels, but perhaps too soon to lock in longer-term assets until certainty over inflation, and resulting monetary control is clearer. Respectfully, let's not reflect recently Silicon Valley Bank and First Republic. Second, maintain liquidity. And to me, that translate as a business operator to maintain focus on profitability and through careful gross margin control. Pursue revenue growth that's sustainable. Manage gross profit carefully. Monitor supply chain for stability and control variable and fixed cost of goods or cost of services in view of inflationary threats, and manage fixed and variable operating expenses. Thanks, Heather.
That's really helpful context, John. Thank you so much. Okay, well, let's switch gears again and move on to the buzzword in tech, AI. I'd love to hear from a few of you about how you think AI will impact the economy and the workforce. So let's start with you, Anne.
Okay, do we have another hour? I mean, AI is transforming the economy and workforce in tangible impacts across industries, right? So, for instance, AI is driving efficiency and innovation by automating complex processes and enabling real-time insights. In finance, it's fraud detection, it's cash flow management. In healthcare, it's diagnostic accuracy and operational workflows, and I could go on and on that, right? I think for me, one of the important takeaways right now for the workforce is AI's rapid adoption is increasing demand for skilled labor in data science, machine learning, and AI system management, with a shift towards higher skill role. And that means that as routine tasks are increasingly automated, and in our world, think about basic data entry in finance, for example, or basic customer service, there's a need for people working in those jobs to reskill or transition to roles that focus on creativity, critical thinking, and AI management. That's in 2 minutes, that's what I can say.
No, those are great call outs, Anne. And I'll tell you, just last week, I overheard my daughter and a friend of hers, who they just graduated about a year ago from college, talking about how AI is going to impact their world and their job prospects. But what about you, Bob? What's top of mind for you here in this with AI?
Sure. Well, Heather, we're already seeing AI effectively eliminating some companies. Take Chegg, for example. Their stock price is down 99% because AI has basically replaced their business model. So what you need to start thinking about is whether or not your business model is vulnerable to impacts from AI. Think about the pre-internet days and stockbrokers, travel agents, and insurance brokers. You get the drift. The big discussion companies should be having now is how to select applications that are AI-driven, such as sales and marketing software, customer support, software coding. It's estimated right now that companies that implement AI-driven applications can increase their profit margins by 1% to 2%. So we think it's a good time to have your management team dedicate some time to discuss how your company can integrate AI throughout the organization. And these should be, frankly, ongoing discussions in your weekly staff meetings or monthly operations reviews.
Wow, thank you so much, Bob. William, let's pull you in to round out this discussion with your thoughts.
Sure. We're at an interesting inflection point in tech. A lot of truths that were held to be self-evident are now being called into question. And it's not just the interest rate environment that's caused this. AI adds uncertainty to this picture, but it also adds huge opportunity. Those companies that are nimble and that have a solid strategic mindset can position themselves for massive success. Services is the biggest part of the US economy, and this is where we are seeing a lot of AI-driven disruption and will continue to see AI-driven disruption. There are going to be a lot of fits and starts, and there's going to be some fine-tuning, not only of the AI models themselves, but of their use cases. But change here is inevitable. Another aspect of the AI revolution that I'd like to highlight is how much of it is being driven by larger, well-established companies. Microsoft's been around for decades, and it's a major backer of OpenAI, and we're seeing very strong adoption of 365 Copilot by a number of companies in the services sector. NVIDIA went public in 1999, and they really are selling pickaxes in the AI gold rush. This, excuse me. So, to my mind, this doesn't at least yet feel like a technological inflection point that's being driven by smaller to medium-sized startups. In a way, it's very reminiscent of the transformation that took place roughly 25 years ago when network infrastructure investment surged. And there was a lot of investment by telecoms companies that laid the foundation for the interconnected world that we're experiencing today. It created a number of new ways of working and created a number of new companies, for example, in cloud computing or in SaaS. So I think in a way we're quite similar in that we're in a very early stage of a transformation that's only just beginning to be felt, with the creation of the underlying AI infrastructure only being the initial part of that package.
Yeah, I would agree, William. This is definitely the first wave in multiple waves to come based on this new technology. So thank you so much. And thank you, Bob and Anne, also for your insights. Let's just move to the full panel. Overall, what would you say are some clear actions that technology companies can be taking in today's environment based on everything we've discussed today? I'll start with you, Bob.
Sure, Heather. I think what you're hearing the panelists say is, first of all, look at your supply chains and consider if you need to diversify or even exit out of some countries. Secondly, do some scenario modeling. Look at how tariffs could affect your revenue and cost of goods sold, which in turn would reflect on your P&L and cash flow. Third, start active and frequent discussions around AI. How do you plan on using AI to improve your productivity and reduce costs and improve profits? And then finally, some very basic tactics. Number one, invest in product. Increase the robustness of your offerings. Number two, invest more in sales. My mantra, revenue cures all ills. Number three, defer all non-essential CapEx. My metric is every dollar in your runway needs to be invested to increase your top line. And if a project doesn't pay for itself in 18 months, defer it. Those are my thoughts.
I couldn't agree more. I mean, so other than doubling down on Bob's recommendations, I'd like to highlight how uncertain things are for the hardware part of the sector. And perhaps that's why Apple's share price barely budged in a week after the election when everybody else's share prices went up roughly 2%. I think we're in for a rough ride on the hardware side. Interest rate movements, geopolitics, and domestic politics are all combining to make that future very obscure. The other thing that I'd like to reemphasize is that we still have a major logjam in terms of getting liquidity back into the tech sector. Other than in the AI space, founders and C-suite executives should not assume that dollars are readily available, whether at the front end in terms of VC investment or the back end in terms of exits. Here's an example. We're seeing a lot of relatively stale unicorns still sitting in VC portfolios, some for 9 years or more. It's going to take a lot of change in the capital and M&A markets, possibly including revaluation, before a number of these companies can exit so that LPs in those venture capital funds can get back to having net positive cash returns, something they haven't seen since 2020.
Yeah, I'd jump in here, and rather than add anything new, I think both Bob and William have identified one of our earlier thoughts, and that is that inflation remains uncertain. And I would, once again, repeat my earlier observations. I would make long-term financing decisions cautiously, and I would focus on maintaining operating liquidity. I would pursue sustainable revenue growth. I would carefully control my gross margins by managing my supply chain and looking at inflationary threats in both variable and fixed expenses and cost of goods, cost of service, and as well in general operating expenses. Thank you.
I think I may add one more thought here. We've heard it from everybody, and it's the combination of the cost of capital being where it is and not going back to where it was a couple of years ago. That's pretty certain, combined with the forces of the AI transformation. And William said it really well. We are at the beginning of it, right? So this is going to be very true and real for all medium-sized and companies in the years to come. You combine those two, I think it's very evident that when companies go out into the market, they need to think about their valuation. We didn't talk about valuation. Their valuation in the market very differently than they have in the past years. So I'll leave it at that, but I think that's an important point.
Maybe I'll chime in. I think a lot of good points have been made. So going last, I don't know if I can add any more, but I think at this point, given where we are, what I'm advising my clients and what I'm doing with my clients is actually more focused inwards. I'm trying to control the controllables, which are, focus on efficiencies, gross margin, supply chain. Bob talked about. This is the things that I can control now. So I'm really focused on finding efficiencies in my operations. I'm spending a lot of time with my clients doing that because I think I can control that. And I think if I can control that, then I have a better way of succeeding when I go out to market, when I raise money. So I'm really focused on operations right now. And I think to that end, I am slowly introducing some AI into my operational efficiency. I think what I would advise folks is you don't have to jump in to dip your toe in the water first. Get comfortable with the art of possible, and then build on it. And I think when your team start to see the efficiency gains, start to see the benefits of AI, they will embrace it more. Then you can go further into the deeper end. But I think those who are starting. Start slow, start simple, build on successes, and then go from there. So I think that's something I've seen work out in some of the clients that I've worked with. So
great. Thank you. Thank you so much, everyone, for this conversation today. So I think, we've had a lot of great content, but let's switch gears and see if we have any questions from our audience. I think I see something from Eric, who is wanting to know if, I don't know if any of you are really tax policy experts, but he wanted to know if we have any update on tax policy, specifically Section 174 repeal. Does anybody have any thoughts on that? And that's open to anyone, if any of you are, keeping your fingers on the pulse of that.
No, I don't have any thought on anything that specific. Nope.
Okay.
Not at this point.
Okay. All right. Well, let's take another question. And can you share more about what you meant when you mentioned small to medium-sized companies needing to build a financial war chest? What is that?
It's really cash liquidity, and it can be as simple as maintaining or considering a line of credit. So many of my clients, I always advise clients when they raise capital to add on some venture debt, to tap on that venture debt in case they need to, and if they haven't done so, maybe now is the good time. And maybe even to draw on that line, because it's easier to draw on a line when you don't need the cash rather than when you need the cash, right? And negotiate with your bankers. Although I would have more thoughts about that, but that's one example.
Got it. Okay.
I don't know if other partners have other thoughts on that. I'm happy to.
Yeah, does anybody want to jump in there or
Yep.
And summarized it very well,
perfect. All
as
right.
always.
All right. Let me move on to one more question, and then if we don't have anything else after that, we can wrap up. Fuad, would you dive into the PE fundraising environment just a little bit more? What do you think is really going on, and what should we be watching out for?
Yeah, I think we've certainly seen a slowdown in the last year or so. In the third quarter 24, global private equity fundraising decreased. The number of new funds dropping by 24% to 189, and the aggregate capital raise was down 22% to 135 billion compared to the previous quarter. So we're still seeing a lot of choppy waters in the PE environment, and I think it's ebbs and flows. However, I mean, having said that, I think we've seen some hardening of that space. There's some signs of stabilization. Some large funds have closed some substantial amounts. I think I talked earlier in my remarks that New Mountain Capital closed a $15.5 billion fund in Q3. And I think it's just emblematic of where the space is. The big players are closing. Players that have history of returning capital and returns. So those are going to be the first ones that will start to raise more money and add to new funds. And then I think the rest will follow as the market does stabilize and they see success elsewhere. But I think less so for the PE, but I think the IPO environment needs to stabilize before fundraising can begin again. I think that's going to be a sort of canary in the coal mine. I mean, we'll have to look at those. Whatever the right metaphor is here, people are going to have to look at those. And once that starts to stabilize, I think the fundraising will improve.
May I pile in on that?
Yes, please.
I just, I think, I made a comment about valuation. I don't know if other people are seeing this, but I've been involved in situations where we've had a lot of private equity buyers come in and look at companies where I've been advising them. And it is remarkable how, and in one situation I'm aware of, where people looked at a company a few years ago and now the multiples have come down. I mean, this is a market where there, depending upon the tenure of the fund, when it was raised, et cetera, to Fuad's point, I think people do have dry powder. But across the board, I'm seeing private equity buyers, not being generous in their multiples and not being generous in their valuation. So, basically what we're seeing is indications that there's a revaluation going on in that corner of the market, and it might spread to other corners of the market.
Got it. Got it. Well, let's see. It doesn't look like we have any more questions, so we can just wrap up. So thank you, everyone. Thank you, all the panelists, and to our audience as well for your questions and for all the valuable insights shared today. I want to invite all of you to sign up for our newsletter. You'll be able to see when we have our next panel discussions, and you'll also get a lot of valuable information from us. But thank you so much for joining me today, and I want to wish you all a great rest of your day. Thank you.
Thank
Thank
you.
you.
Bye, everybody.
Thank you. Bye-bye.